Hey everyone, welcome back to Corporate Decoder, the place where we dig through the boring stuff so you don't have to. Today we're cracking open Douglas Dynamics' latest report, and let me tell you, some of their numbers are about as exciting as watching snow melt in July. But stay with me, there are some interesting details we can dive into. This report basically tells us how well they did in the first 3 months of this year. Net sales look pretty good, but net income it's close to $0 after all the expenses. Let's find out why and if this company is heading in the right direction. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. You will find many experts ready to analyze this stock. First off, this is a quarterly report called a 10Q. Douglas Dynamics is an accelerated filer, meaning they're big enough to have to report quickly, but not big enough to be a large accelerated filler. They're traded on the New York Stock Exchange under the ticker symbol PLO. How fitting. As of May 6, 2025, they had about 23.2 million shares of common stock floating around. Now that the basic stuff is out of the way, let's dive into the money. Alright, let's take a look at the balance sheet. It's like a financial snapshot of what the company owns and owes. Looking at current assets, we can see that net accounts receivables are down to $69 and $27.47 here, which means they're collecting payments slower than before or selling less, but that's not all the story. Their inventories are up, which could mean they're expecting more sales later or having trouble selling products right now. Property, plant and equipment, their physical assets, are sitting at about $40.8 million. No real change from last year. Goodwill is still at $113 million goodwill. Basically appears when a company buys another one, but is very susceptible to problems as we will see later on. Other intangible assets like patents are down a bit to $112 million. This mostly means that the value they have on patents and brand names is decreasing. Overall, total assets went up to $621 million from $590 million, which is good. It means they are expanding overall. Switching over to the liability side, accounts payable are up to $42.9 million. This means they're taking a little longer to pay their own bills or buying more from suppliers. Total current liabilities went up quite a bit to $115.82 million from $70.02 million. Zero-term obligations now. Finally, we have the owner's equity, retained earnings. Their accumulated profits took a hit down to $81.6 million. Overall, total stockholders' equity is down slightly to about $258.9 million. Nothing too concerning, but not ideal either. Now let's look at the statement of operations, what everyone actually cares about, the real juice. Net sales jumped to $115.5 million. That's a nice 20% increase. But cost of sales is up to $86.9 million. It's important to note the cost is smaller than the revenue increase. Gross profit is $28 year. It means their actual business of selling snowplows is much more profitable than last year. It means their actual business of selling snowplows is much more profitable than last year. Selling, general and administrative expense also took a small jump. Amortization of intangibles is down, which is also good. After all that, income from operations is positive. This is a huge jump compared to last year where they were losing money. This means they made better choices that led to profitability. Interest expense $2,004 million. Data ed debt modification loss on extinguishment of debt. We have additional costs there which are not ideal. The bottom line, net income is very tiny. Overall, net income is $0.11 million and an improvement from last year's $8.4 million loss. But this is very tiny money for a company that has $621 million in assets. They're still paying out dividends of 30 cents per share. The comprehensive loss, which includes a few extra accounting measures we won't get into, it's a negative number. Better to be negative by a little than by a lot last year, but that means it's worse than having profit. They used $1.3 million in operating activities, which is better than last year. In accounting language, this means that if they relied on the business to make money, they would have been losing money overall. Now the business is profitable due to cash flows. On the investing side, they spent $2.2 million on capital expenditures. That's investing in their future. They generated $5.6 million from financing activities, like taking on debt. The company recently refinanced some debt, which means they're trying to get better terms, and that leads to fees. Overall, their cash went up by about $2.1 million. Quick look at equity, nothing really stands out too much. There was a stock-based compensation, but that is not that high compared to other metrics. Let's see a bit more detail about the sales. Most of their sales are still to independent dealers, but that accounts for roughly 50% of the revenue, with government and fleet being the rest. Revenue is mostly point in time instead of a service that you provide over time. Regarding their risk management, they don't seem to be afraid, with their losses on accounts receivable being pretty small. This suggests that they are good at selecting their customers and working with them. They do some interesting things with their money. For example, they have non-qualified benefit plan assets of about $10.6 million and also use steel hedging instruments. But at a high level, it doesn't seem like a significant amount. They refinanced their debt, which resulted in some expenses. These guys are paying more to get less, which is never good. Most of their facilities are leased, not owned. This is very common, but you might consider as a downside. They are renting their factories rather than owning them. Okay, that's the financials. Let's move on. They've got the usual legal stuff, no big lawsuits looming, and nothing too exciting about their environmental responsibilities. They operate in two segments: work truck attachments, snowplows and stuff, and work truck solutions, upfitting trucks. The work truck attachments business is usually highest in second and third quarter, as it all depends on the winter. And it seems that, as mentioned before, they got a new CEO, Mark Van Genderen, in March, which is always a big change in a company. Of course, they've got risks. Number one is always the weather, since a mild winter means less demand for snowplows. They also rely on good relationships with their suppliers, and a downturn in the economy could hurt them. Also, potential lawsuits. But hey, every company faces risks. Finally, an interesting disclosure I found: they are amortizing assets for several years. It doesn't look like a liability anytime soon. Regarding accounting changes, there are a few updates from the Financial Accounting Standards Board coming down the pike, but they're not effective yet. Alright, that was the Douglas Dynamics report, and that was the story. Now, looking at these results more broadly, I believe they're heading to the right direction and taking smart measures to improve profits overall, as we've seen with the FT 48% gross profit. The sector is obviously very connected to the weather, which is a factor they can't control, but they seem to be operating reasonably well with the hand they're given. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.